This chapter 2 introduces the simplest form of asset swap and teaches you how to derive from a par bond's coupon and maturity and from the risk-free interest rate curve the spread over LIBOR that can be created synthetically by swapping a fixed-rate bond into a LIBOR-based instrument, and the risks and benefits of such a structure. We begin by considering an investor that funds itself at LIBOR and is contemplating an investment in one of the 4 fixed-rate bonds described in Chapter 1, whose characteristics are repeated here for your convenience. Simply purchasing one of the bonds and funding it at LIBOR would leave the investor exposed to a significant interest rate mismatch, and specifically between the fixed return on the investment and the LIBOR-based floating interest rate it pays on its funding. A substantial increase in LIBOR rates would erode any positive spread from this strategy and quite possibly turn it negative in many cases. The investor, therefore, checks the screen for 5-year semi-annual interest rate swap rates and finds that number to be 6.3%. The investor proceeds to draw this diagram describing how it could purchase the U.S. Treasury note, funding it at LIBOR, and enter into a 5-year interest rate swap with a bank counterparty under which the investor receives, as you see here, 6-month LIBOR under the swap and pays 6.3% fixed. This combination leaves the investor with a stream of cash flows that would be essentially identical to an investment in a hypothetical U.S. Treasury issued floating rate note yielding LIBOR minus 30 basis points. It is not surprising that this yield is lower than the investor's funding cost, since the U.S. government should rightfully be able to borrow at rates lower than anyone else and certainly lower than a private sector bank. So while the investor would be unlikely to engage in this transaction unless it has a compelling non-economic reason to do so, for example, to comply with perhaps regulatory requirements, or as part of its liquidity management policies, the structure has nonetheless enabled the investor to calculate exactly what spread relative to its funding cost it could achieve if it did decide for any reason to purchase the U.S. Treasury note but not to tolerate the interest rate mismatch risk. The answer specifically being a negative 30 basis points in this instance. The name given to this package, consisting of the fixed rate U.S. Treasury note plus the IRS attached to it, in order to generate a synthetic floating rate investment, is quote unquote asset swap. In its quest for a higher return, the investor now persuades itself to accept the credit risk of JP Morgan and therefore removes the U.S. Treasury note and replaces it with the Morgan bond in the asset swap package. We see very quickly that the asset swap package now yields LIBOR plus 10 basis points gross, or a positive 10 basis points net over the investor's funding cost of LIBOR. The simple trade-off here is the acceptance of slightly greater credit risk to turn a negative 30 basis points of spread into a positive 10 basis points. We will discuss a little later the consequences of a default by the note's issuer under an asset swap, which does complicate matters a little in our analysis. But ignoring that for now, the yield comparison between these two investments is straightforward. It is worth analyzing how the total value of the asset swap package reacts to movements in interest rates, both generic shifts in rates as well as ones that are particular to the issuer of the underlying bond. Take the case first of a generic increase in rates due to a parallel upward shift in the risk-free curves, a term in which we include both the U.S. Treasury curve and also the almost risk-free IRS curve. Specifically, we assume in the example with the U.S. Treasury note asset swap that both the 5-year U.S. Treasury rate and the 5-year IRS rise by 50 basis points shortly after the asset swap is constructed, i.e. to 6.5% and 6.8% respectively. This worksheet, MTM, shows the change in value of each component, U.S. Treasury note and the swap, of our asset swap package, and also the aggregate change in value. Naturally, we expect the U.S. Treasury note to decline in value when rates rise, and indeed find its new price to have fallen to 97.89 of par, i.e. a discount of 2.11%. Note what we've done here is adjusted upward the discount rate from 6% to 6.5%. The swap, of course, begins life with 0 NPV, assuming the dealer has taken no profit out of the transaction, and then is revalued essentially as a 5-year annuity of 25 basis points semi-annually, whose PV is revealed in the cell F8 of the worksheet to be 2.09% of the swap notional amount. The total package, as shown in cell H8, has barely budged in value. There are several ways to think of this phenomenon. An intuitive approach simply observes that the asset swap package has essentially duplicated the cash flows of a floating rate note, or FRN, which is known to be largely insensitive in price to movements in the risk-free curve. A slightly more sophisticated analysis is to remember that both the U.S. Treasury note and the IRS come with something called modified duration attached to them. The U.S. Treasury note can be shown to have at inception a modified duration of some perhaps 4.3, while the IRS has a modified duration of very nearly the same amount, but in the inverse direction, as far at least as the investor is concerned. The asset swap package, therefore, which consists of the sum of these two instruments, must therefore have a modified duration of almost zero, since modified duration is additive when the weights, in this case the notional amounts, are equal, and therefore would be insensitive to identical shifts in the two risk-free curves. It is precisely for this reason that the asset swap package appeals in particular to institutions and entities that are especially averse to mark-to-market volatility on their bond investments, such as certain conduits and other vehicles that need to maintain the greatest possible stability of asset values due to their very high leverage. The very small price loss of 2 cents in our previous example is attributable to the fact that we discounted the U.S. Treasury note off the U.S. Treasury curve, while the swap cash flows were discounted off the slightly higher yielding IRS curve. Now assume the asset swap package with the JP Morgan note is revalued shortly after inception, and that in addition to the 50 basis point shift in the U.S. Treasury and IRS curves, that the JP Morgan credit has deteriorated, so that its credit spread to the U.S. Treasury curve at the 5-year maturity point now lies at 200 basis points. This means that the cash flows under the JP Morgan bond should now be discounted at 8.5% all in. Our old worksheet, MTM, right underneath the part we previously examined, so starting around row 11, illustrates again the valuation of each component and of the total package, and indicates this time, first, a substantial drop in the price of the Morgan bond, since both the risk-free rate and the credit spread have risen in this example, a change you see implemented in the addition of 2.5% to the discount rate. Second, the same effect again, a gain of 2.09 on the interest rate swap, and therefore this time, third, a substantial loss on the aggregate package of almost 8% of par, due almost entirely to JP Morgan's credit deterioration, which the interest rate swap by itself does not offset in any way. In summary, use of an interest rate swap to neutralize a bond's modified duration, and specifically the bond's tendency to decline in value as its cash flows are discounted at higher rates, works, but only when the higher discounting rates are due to movements in the risk-free curves. It cannot offset issuer-specific credit deterioration that is not also captured by movements in the swap rate generally. Of course, it is precisely for this reason that credit derivatives were invented sometime in the mid-90s. You have realized, most likely, how much simpler our work has been so far on account of the fact that the bond underlying the asset swap was trading at par when it was purchased. So that each of the bond's purchase price, its redemption value at maturity, and the notional amount of the IRS can be set to equal 100, rendering our analysis of the ultimate cash flows quite simple. If, however, the bond is not trading at par, as with the one from Alcatel, for example, we would be left with a nasty problem conceptually and in practice. Our diagram from the Morgan example is repeated here with the Alcatel bond substituting for Morgan's, and specifically with Alcatel's 5.5% coupon replacing Morgan's 6.4% coupon. Initially, it may seem as if the asset swap now yields, as you can see, only LIBOR minus 80 basis points. But this is clearly wrong, since it would be indicating an all-in yield inferior to all other alternatives, including even the US Treasury alternative, despite the far higher yield to maturity we originally calculated for the Alcatel bond. Click pause for a quick second and identify what is missing in our analysis. Probably you realize right away that the critical feature absent from our new diagram is the 8% discount from par at which the Alcatel bond was trading, which has not been reflected at all in our calculation of returns. This substantial discount clearly boosts the actual all-in return significantly. Indeed, by more than 160 basis points per annum, even ignoring the time value of money and simply applying a linear amortization of this discount of 8% over the 5-year life of the investment. This in turn would lead us to a very rough estimate of LIBOR plus 80 basis points instead of minus, which at least, quote-unquote, heads in the right direction, so to speak, relative to the US Treasury and the JP Morgan asset swap packages. And we should not be surprised to find the correct answer quite a bit higher when we correctly apply time value of money notions to the amortization of this upfront 8% price discount. And yet, in simple cash flow terms, the Alcatel asset swap package continues to suffer from its depressed periodic coupon. The investor purchasing this asset swap package would fund $92 over here on the left at LIBOR, but would receive at the end of each period a mere LIBOR minus 80, albeit on a $100 notional, appearing now on the right in red. And this may be less even than the investor's funding cost in strict cash flow terms that has just appeared in red on the left. To illustrate, suppose that LIBOR has reset at 5% for a certain 6-month period, so that the coupon paid to the investor at the end of that period under the asset swap package would be 100 times 4.2%, which is the 5% minus 80, divided by 2, or times 0.5, because it's 6 months, equals $2.10, while the investor's funding cost for that period is approximately 92 times 5% over 2, which is $2.3, which still represents negative carry for the investor from a cash flow perspective, despite the substantial benefit that the coupon is paid on the full par value of the package, while the funding costs are paid, of course, on $92 only.
It is only at the end of year 5 that the gravy, so to speak, from this trade arrives. Specifically, when the investor receives the full 100 from Alcatel that just appeared now in black on the bottom right of the diagram, but pays off on the bottom left in black again only $92 on the funding which it had incurred 5 years ago, and thus finds itself with a nice capital gain of $8, which transforms a mildly negative cash flow of some 20 basis points annually into a solid, positive, all-in yield margin calculated over the entire life of the trade that is visibly many dozens of basis points at least. What the investor ideally wants, presumably, is to have this $8 capital gain expected at the end of the trade somehow built into the asset swap package over its 5-year life and paid to the investor ideally in the form of equal semi-annual installments that supplement the LIBOR minus 80 coupons under the asset swap package, converting the investor's 20 basis points of negative cash flow carry into something nice and comfortably positive. Chapter 3 will show you how this is done in practice.
We conclude this chapter by examining an important difference between an asset swap package as previously constructed and a floating rate note issued by the same company and having the same maturity and payment frequency. The difference we are referring to is the introduction into the asset swap package of breakage risk under the swap in the event that the underlying bond defaults. Specifically, in addition to the losses that the investor would incur from the defaulting fixed-rate bond, the investor may also incur additional losses from having to unwind the interest rate swap prior to its maturity. To be sure, depending on how interest rates have moved since inception, the swap unwind might alternatively generate a gain for the investor that offsets to some degree the inevitable loss on the underlying bond, since the standard ISDA documentation allows the unwind payment to flow in either direction depending on whether the swap's mark-to-market at that point, i.e. its fair value, is in favor of the investor or of the bank counterparty. Nonetheless, the introduction of this additional element of uncertainty is a negative on a net basis for the investor, and means that if the spread over LIBOR of the asset swap package is not significantly superior to that of the FRN, then ceteris paribus, i.e., ignoring other differences that may pull in one direction or the other, such as liquidity or documentation differences, the FRN would probably represent the superior investment. To illustrate, imagine a 7% 5-year bond trading at par that is swapped into floating when the 5-year swap rate is 5% for a semi-annual payment frequency. The asset swap package generates an all-in return for the investor of 6-month LIBOR plus 200 basis points, as illustrated in this diagram. Now suppose that after exactly 1 year has passed, the 4-year swap rate stands at 4%, again for a semi-annual payment frequency, and that now, at this very moment, the bond issuer defaults, causing the bond, as you can see in the top left, to trade at a value of 45% of par. The fair value of the swap at this point will represent the PV, present value, of the difference between the original 5% paid by the investor under the fixed leg and the current rate of 4% available for the remaining maturity of the swap. This can be easily shown to equal 4.5%, a loss to the investor that would be additional to the loss of 55% incurred on the bond itself, and would bring the total loss to just about 59% of the original invested amount. Of course, the longer the remaining maturity of the swap, and the more rates have risen from the original swap rate, the greater this additional loss would be. To eliminate this additional concern, something known as a perfect, quote-unquote, asset swap has been developed in the marketplace, which involves the normal asset swap package, except for the use of an IRS that, by its very terms in the contract, states that it simply vanishes if the underlying bond defaults at any time, whether the fair value of the swap at that moment is positive or negative for the counterparty. In essence, the providers of this solution are projecting into the future the likely correlation between the credit condition of the bond issuer and the swap curve for the package's remaining maturity. If there is no reason to expect a correlation different from zero, the pricing of the IRS involved in a perfect asset swap should be pretty close to that under a normal IRS. But if, for example, the correlation is expected to be positive or negative, for example, if the issuer is a construction company for residential real estate whose credit condition is likely to worsen when interest rates are high and fewer people can therefore afford homes, then the fixed leg of the perfect asset swap would be increased.
This would reflect the bank's expectation that if the issuer of the bond defaults, rates are more likely to have risen than fallen, so that absent this walk-away feature under the perfect swap, the swap's fair value at that time would be in favor of the bank. And conversely, if the issuer default is more likely to occur when rates have fallen than when they are high, i.e. when a normal swap would have a negative PV from the bank's perspective, the rate on the fixed leg of the perfect swap would be reduced. In a more advanced module on exotic credit derivatives, we will discuss in detail the pricing of such an instrument. This completes Chapter 2.